Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Air cover from the Bank of Japan, a pledge to refrain from hiking interest rates when the markets are unsteady. The stock rally endures, volatility subsides, hedge funds and institutional money buy in size. And the Democratic ticket is set. Vice President Harris picks Minnesota Governor Tim Walsh as her running mate to block Donald Trump from returning to the White House. A very good morning to you. So the soothsayer message has arrived from the Bank of Japan, which is that they are on pause. That air cover has invigorated the pro-risk stance on a global basis. Equities are higher in the United States of America. You've got dollar-yen, as you can see there, dollar moving higher by 2%. More on that in just a moment. But the flow of money is very clear. Goldman Sachs say that hedge funds have reversed their tech unwind. They were the most underweight in 10 years. The hedgies are calling in from the Hamptons and loading up and looking large when it comes to the tech position. Russell up 1.65%. JP Morgan say $14 billion worth of institutional money played into this market on Monday alone. Airbnb, you're not traveling. The reality is something different in the real economy, and we will debate over the rate cut narratives for the Fed. Look at that Airbnb down 16%. There are signs of slowing demand, and this is the critical issue. From McDonald's through to Nestle, through to Heineken, the reality of the consumer on a global basis is changing. Let's get straight to the Asian session. I give you a complexion of what's gone on. As I say, Bank of Japan's Uchida calls for a pause. We won't raise rates until when the market is unstable. We need to qualify what stability is. We've moved by 5 big figures in dollar-yen, 141.70 to 147.15. So we've moved even more than that. Again, re-establishing some of the wealth within Japan after a $1.1 trillion wipeout. That's the Nikkei, up 1 1/8% this morning. 10-year government bonds. This is interesting. We're rethinking the rethink from BMO. The rate cut narrative in the United States of America has got slashed aggressively from 5.5 cuts, in other words, 150 basis points to where we are at around 100. We didn't even see that in 2007. It's going to be tougher, perhaps, to get the 10-year and the 30-year bonds away. But let me take you to the thinking in the market. This is from UBS, from the chief economist, from Paul Donovan. It's a lesson for you all. Central banks are not supposed to create disorderly markets. I think we can review that. So this is not necessarily surprising that the last rate hike will not be reversed. From the Bank of Japan, this is. The political pressure on the Bank of Japan to raise rates was not properly backed by the economic fundamentals. There is a lesson there for all central banks when it comes to the chiding of cuts, when it comes for the calls for hikes. My guest this morning is timely on the FX markets. Valentin Marinov, head of G10 FX research at Crédit Agricole. Valentin, good to have you with me. My question to you is simple. Has the Bank of Japan capitulated to real pressure of volatility, but delivered the air cover to slow the carry unwind? Good morning.
Good morning, Manus. Well, indeed. I mean, you could say it's the case that the BOJ will be proceeding much more cautiously from here, especially given the political backlash you alluded to that became apparent already yesterday. And as a result, as you said, a collective sigh of relief across the markets. Carry trades or yen-funded carry trades are back in vogue. It could be it is a possibility that in the very near term, some investors will be tempted to dip their toe back into yen-funded carry trades. I personally think dollar-yen could be heading closer towards 150 yet again on the back of those developments. That being said, I think that the best days of carry trades are truly behind us, and I do believe that we have seen the lows in yen. So from that point of view, whereas in the interim we may see the yen depreciating a bit or carry trades coming back in vogue, I think the ultimate direction of travel would be further unwinding of carry trades from here.
OK, so you'd have to be fairly brave, Valentin, I'd say, to jump in and do new carry trades. OK, what qualifies stability for the Bank of Japan? Because that's critically important, and that will define whether they can hike again. 30% probability for October. That is what the OIS swaps markets say. That is not a consensus to hike. So in your mind, what qualifies stability for the BOJ?
Well, I do believe they'll be looking at both FX and potentially Nikkei volatility there. I mean, it is an open question as which particular measure they will be looking as a whole, but at least my interaction with them has suggested that annual changes for them are indeed of quite significant, especially when it comes to the FX markets. So presumably, if indeed that volatility dies down from here, that may give them some comfort and indeed pave the way towards the next hike on their side. I do believe also that in reference to what you mentioned earlier regarding fundamentals, Japanese wages are indeed accelerating. Real wages turned positive, or real wage growth turned positive more recently. And I think that in and of itself certainly argues for further policy normalization. I don't think that financial market instability will derail BOJ's progress towards normalization. It will slow it down, though. So therefore, I believe in terms of horizon 6 to 12 months, maybe your target when it comes to really dollar yen, really, or in particular the Japanese yen, appreciating more meaningfully in response to more meaningful policy normalization. In the next 3 to 6 months, I think the financial instability concern may slow down the process of policy normalization quite significantly.
On a 3 to 6 month horizon, then, am I sort of from a market perspective blocked at 140? Is there a big psychological blocker at 140? If that dam gives, that is another wave of carry unwind.
Well, in terms of levels, you would think that 140 may be indeed the level on the downside for dollar yen, where essentially the yen rally would stop. And I guess from here into year end, I would think that we're going to have those bouts of yen selling, yen buying from here. And obviously, having experienced what happened really in recent weeks, it is clear that financial stability considerations will remain an important driver of BOJ's policy from here. And that, I have to say, should count really against the yen for the time being. And therefore, I believe for real further gains and long-term fair value for dollar yen is anywhere between 110, 120, really those levels. I don't think we will reach those levels before mid of next year or indeed end of 2025 as a result.
Okay, so that's a long distance call out into the back of 2025. Near term, what the Fed have to deal with is this. We saw a market go parabolic in terms of rates pricing, 5.5 rate cuts, 150 basis points. They only did that in 2001, heading into a recession. In 2005, I was chatting to one of our guests on the IB. In 2007, they did 50, 25, and 25. So when you look at the cadence of cutting from the Federal Reserve, I just called out Airbnb. The stock is down 15%. Idiosyncratic information from the real economy is something different to the GDP trackers that we've got from yesterday, etc. The Atlanta Fed GDP tracker saying a very healthy number. So with this repricing, the volatile repricing in rates, do you think 50 basis points is appropriate in September?
Well, I mean, it is a possibility. And one reason for that would be the fact that the November Fed meeting will essentially coincide with the US presidential elections. But beyond that, I think that the repricing of aggressive Fed rate cuts is likely to continue. I personally don't think that the Fed is going to cut 4 times this year, as implied by the markets, really at the moment, at least. It is the case that the US data has shown some weakness and is expected to signal further slowing of the economy. But I think the Fed will want to take it a bit more slowly, especially given that while weaker inflation remains uncomfortably high. And I guess I should also mention something that people are forgetting altogether, the experience we had from last year when we had a number of US banks really failing, and that's certainly sending shockwaves across the markets. The Fed did not pause its tightening cycle. It did not cut rates. Instead, they pumped in more liquidity. People are forgetting that the Fed has a number of tools at its disposal to deal with financial market turbulence. And rate cuts may not be the preferred tool just yet, just because inflation is too high and indeed the economy is sufficiently resilient. And this is partly behind the, I would say, bullish dollar yen call from current levels in the near term. It is the case that even if the Fed were to cut rates in September, September. I do not think that this is going to be accompanied by forward guidance suggesting that an aggressive easing cycle is underway.
Okay, I'm seeing messages come through to me here, which is sell the you cheated bounce. Okay, Valentin, thank you very much. It's going to be a frisky market, certainly between now and the end of the year. Valentin Marinov there, off credit Agricole. There are other stories apart from the Bank of Japan on your Bloomberg terminal this morning. Let's kick it off with some corporate news. SoftBank announces a buyback worth $3.4 billion to bolster its stock price after a month of sharp sell-offs. The move comes after pressure from its activist investor, Elliott Investment, which built a sizable stake in SoftBank this year. Glencore has abandoned its plans to spin off its coal unit. The decision comes following discussions with shareholders who pushed back against the move. Glencore's coal business is one of the most profitable units, driving record returns in recent years. Growth of China's exports unexpectedly slowed in July, signaling a cooling of global demand. Domestic consumers are also spending less. Meantime, China's imports rose, driven by chip equipment orders ahead of a potential U.S. curve. Coming up, politics matter. Minnesota Governor Tim Walsh will be the Democratic ticket. We'll examine just what he brings to the Harris campaign. And later in the hour, I catch up with Kevin Mahn, President, CIO of Hennion and Walsh Asset Management, about the Fed's rate path. Context matters every day on Bloomberg.
Donald Trump's not fighting for you or your family. He never sat at that kitchen table like the one I grew up at, wondering how we were going to pay the bills. He sat at his country club up in Mar-a-Lago, wondering how he can cut taxes for his rich friends.
That was the Minnesota Governor Tim Walsh speaking at a rally in Philadelphia yesterday after being officially named as the Vice President Kamala Harris's running mate. Our chief political correspondent, Amory Horder. I don't think she's had any sleep for the past month. Good to see you.
Good to see you.
So this is her running mate, and yet you sent me a poll that says 70% of America don't know and haven't heard of Mr. Walsh.
Yes, so this new poll by Marist was done before he was tapped as the running mate. But it's true, he has to really reintroduce himself, not just to Minnesota, where he is well known, but as a VP candidate, but now to the nation, to the rest of the world. Very unknown, the dark horse candidate in this Veep stakes, and he was chosen. And I think the Wall Street Journal editorial board put it well today when they led with Trump doubled down on his base with picking J.D. Vance. And you do see Kamala Harris doubling down on the progressives and her base by picking Tim Walsh, the governor of Minnesota.
I mean, you just look at some of the tweets from the progressive side, and specifically we're talking about Alexandria Ocasio-Cortez. Govern effectively, inclusively, boldly, calling his addition to the ticket an excellent decision. Give me a sense as an outsider, the size and the heft of the progressives and how important it is to bring them more on side, because Biden had tried, but perhaps maybe not as effectively as this ticket.
Well, I think potentially what both parties are trying to do is turn out their bases and run up the numbers on their bases. Something you get from Tim Walsh is Minnesota is already blue, but potentially he can speak to those individuals in the Rust Belt, in Michigan, in Wisconsin, something that Governor Shapiro would have definitely been able to do as the governor of Pennsylvania, but they decided to go with this individual. He has an arc when it comes to policy. He was in the House for 12 years, and he was definitely more of a moderate in the House. And as governor, he's definitely mean policy-wise towards more progressives. You're going to see criticism and some concern from conservatives when it comes to things like gender-affirming care in Minnesota. They're going to be a lot of criticism about how he responded with the upheaval on the streets after the killing of George Floyd in 2020. Many said he wasn't quick enough to bring in the National Guard. So these are going to be the pressure points. But at the end of the day, yesterday there was a lot of excitement in that room. The same way there's a tremendous amount of excitement after Donald Trump spoke at the RNC after that assassination attempt on his life. There's a tremendous amount of excitement from the base in that room, which Biden wasn't getting. Now this is a fresh new ticket, and they have a shortened time span to get out there, and potentially that's going to work in their favor.
I mean, Speaking about that convention yesterday, at one juncture during the speech, he talked about Trump being a convicted criminal. And of course, this goes back to the chants of the Republican Party, lock her up. Of course, they were chanting, lock him up. Again, this is a reinvigoration, as you say, of a political base. Is this going to be a very, very different campaign to the one under Biden in terms of using, we've seen it, a lot more social media, a lot more live event. What's going to shift here? Are they going to run in parallel? Are they going to be joined at the hip? Or what are we going to see from this campaign?
So the next week, this upcoming week, you're going to see them join at the hip. They're going to hit up all the hot spots around the country. They started out in Philadelphia. Pennsylvania is basically the Florida for Republicans, what it is for Democrats. It is must win. And you see there, Trump has made a tremendous amount of inroads, and it's a state he won in 2016. So they kicked off there, a little bit awkward for Governor Shapiro, who got the shrug. But they're going to be hand in hand. And then they're basically going to say, we need you in the Midwest. He's going to be countering J.D. Vance. I think something also that's different from this group is already you can see the excitement with the Gen Z generation on TikTok, something Biden wasn't bringing in.
Okay, got the shrug. There's the phrase of the day, got the shrug. But is Shapiro has he got broad shoulders to be politically useful? Anne-Marie Jourdain with the very latest on the Washington moves. Coming up on the show, I'll take you through all the other major headlines making news around the world. Novo Nordisk also sees a reverse setback. The stock is down 3 1/8. We'll take a look at what's weighing on the stock. Context matters every day on Bloomberg from New York. Good morning.
Second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So we really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
That was the Novo Nordisk CEO there speaking to Bloomberg a little bit earlier. The shares dropped this morning. The Danish drug maker reporting softer than expected sales for the weight loss drug Wegovy. Here with a little bit more detail is Sanna Vase, who has the key takeaways on these results. I mean, this is a slight moment of humble pie because Wegovy, Ozempic, both underwhelming, and the guidance as well. So is this a moment of a stumble or something more?
I mean, certainly there is some doubts creeping into the market, but interestingly enough, Novo actually increased its sales of these blockbuster drugs, Ozempic and Wegovy, and it also raised its sales forecast for the year. But it just didn't seem to be enough for the investors, and that's why we're seeing the share price down today. Novo missed estimates on Wegovy sales and Ozempic sales, and it also went out to say that it would continue to restrict sales of Wegovy starter doses in the US. So there seems to be still some way to go for the company to really meet that demand that there is out there. And of course, Novo also lowered its profit estimates, or profit forecast for the year, which really also shows that Novo is facing some bumps in the road. And this past quarter, it had to take quite a big impairment charge due to a failed study of an experimental heart drug. And so, of course, that's also a drag on profits and impacted the forecast.
Look, this is just one of those days when management have got to stand up. They've got a bump in the road. They haven't had this so far. It's been all hail, all glory, Ozempic, pens are us. But in terms of the trajectory, you've got the bullish side, which is the CEO says, we're in the early days of saturating the US market. But where is the competition on that? Is that what investors are most frightened of here in the United States of America?
I think investors are generally concerned of any little news that could potentially challenge Novo on this growth journey that it's on. We have seen also growing competition from Eli Lilly, which now has a product on the market, and also other pharmaceutical companies that are now starting or exploring weight loss drugs. Swiss pharmaceutical company Walsh has now advanced a trial of a weight loss pill. But anything, investors are of course looking at any little news that could challenge Novo, because as you say, there has really just been a Novo mania lately. In the past year alone, Novo shares have risen 60%. So any little thing that could challenge that, investors are getting concerned.
Okay, Sana, thank you so much. As you say, a bump in the road for today, Sana Vase, there on the Novo Nordisk numbers. We're going to dig into some of the equity markets and whether you can trust this rally. But let me leave you with a snapshot of where we are right now. The Bank of Japan delivers verbal coverage for a pause in the unwind. That has delivered a little bit of a bid to the equity markets. Let's have a look at some of the equity markets there in terms of where we are. US equity futures are just a little bit higher at the moment. We are up on the Nasdaq by 1.3%, and S&P 500 up over 1%. Kevin Mahn joins me shortly. Our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. A cover arrives from the Bank of Japan, a pledge to refrain from hiking interest rates when markets are unsteady. The stock rally endures, volatility subsides, hedge funds and institutional money arrive and buy in size. The Democratic ticket is set. Vice President Harris picks Minnesota Governor Tim Walsh as her running mate to block Donald Trump from returning to the White House. The cavalry have arrived and stocks are rallying. The Bank of Japan has been pressured into a verbal retreat. Not a change in rates, but a soothsaying message. The Bank of Japan's Uchida says, we are on pause. We're not going to hike. We're not going to move. We're going to stay as we are until we see stability in markets. That has invoked a risk-on narrative. We see a carry-through on the equity side. Is it that the Bank of Japan has delivered air cover, or is there something more substantial? Goldman Sachs say the flow is here. The hedge funds are calling in from the Hamptons. They were the most underweight in tech in 10 years, and they have begun to buy. Single-name buying, according to Goldman Sachs, was the most net buying since March. JP Morgan say $14 billion of institutional money arrived in. Dollar-yen is the ground zero for risk on. That is the dollar up, the yen down by over 2%. Valentin Marinov of Credit Agricole says, look, this run over the next 6 to 12 months will be volatile. You're not going to get to 110, 120 until the end of 2025. Airbnb getting crushed this morning. You need to get out there and travel. The signs of slowing demand. This is, again, another message from the real economy about what's going on. To the bond market and to the Japan session. The bond market, as you can see, is trading at 393. We were over 4% on the very short end of the curve. Tens have moved up by 10 basis points yesterday. The message from the Bank of Japan, Uchida, is pause. We've moved by 5 big figures on dollar-yen after a $1.1 trillion stock meltdown in Japan. That is called wealth destruction. The single biggest three-day move since 1959 on the topics and 1970 on the Nikkei. So we are looking for a more orderly unwind of the carry trade. You will get a little bit of auction in this market today, 10s and 30s. The 3 years went fine yesterday. So where are we on the great unwind and the jolting of risk and equity markets? Well, the Goldman Sachs CEO, David Solomon, sat down with David Rubenstein on whether we see more volatility in the future.
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we have discussed. In certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape.
Well, Kevin Mahn is the president and CIO of Hennion and Walsh Asset Management. He joins you now around the desk. Look, David Solomon, many people have seen many huge volatility periods. Here we are. Solomon says it was sort of like a healthy moment. I sort of challenge that. There was nothing healthy about the moves in the bond market that I saw on Friday and Monday. There was nothing healthy about that. I understand the principle that it may provide an opportunity, But how healthy an unwind has this been?
Yeah, I've been doing this for over 3 decades now, and investors never appreciate when we see significant market pullbacks like that over a short period of time. But let's look at the reasons why this particular pullback occurred. In your earlier segment, you touched upon one of them, the Bank of Japan surprising with that upward move in interest rates, which caused this global reversal of the yen carry trade. That unwind isn't done just yet. Second factor, last week, the Fed didn't actually lower interest rates as some, such as myself, were expecting, and taking a slightly more hawkish turn. And the third biggest factor, of course, was that July jobs report. It reminded everyone that perhaps the economy isn't as good of a footing as many earlier expected.
But let's put context around this. The yen drops by 2%, the dollar rallies by 2%. This is, as I framed it, as air cover to try and just quell the speed of the carry unwind. But you would still say there's another leg to go in that unwind, and that these rallies in dollar or this drop in yen, whichever way around you want to look at it is perhaps an opportunity for more divestment rather than taking more risk.
Yeah, absolutely. And I think the yen carry trade is just one small part of the overall equation. The bigger part is the job story. We saw unemployment rise to 4.3%. The Fed, as of their summary of economic projections in June, were only expecting to end the year at 4.1%. We've already blown through that. So will the Fed be late to the party once again? Are those 3 rate cuts back on the table? Or perhaps are we now going to see a 50 basis point cut in September? All that creates uncertainty. All that will create more short-term bouts of volatility. But I do think with that volatility comes opportunity away from, but not necessarily abandoning, those large cap growth technology stocks.
I'll come to that in a moment. We caught up with Claudia Sam on Monday, Jonathan, along with Danny. Her point to the market was calm is important.
Yes.
We are uncomfortably close to a recession. So this is about slowing the momentum, slowing the drop. Right. So this is about slowing the drop. To slow the drop, the market convulsed and went 5.5 cuts. We're back to 3. We're back to 3, maybe 4 cuts is where we are at the moment. What slows the drop in your mind and puts a floor under risk?
Earnings.
Okay.
Earnings have always driven the market, and over the course of the last 12 months, 83% of the earnings growth in the S&P 500 have come from those magnificent 7 technology stocks. We need the other 493 stocks to start significantly growing their earnings as well. Fortunately, they are forecasted to catch up to the Mag 7 by the end of next year, going into the first quarter of 2025. So I think that creates the opportunity for investors to diversify, not abandon the Mag 7 stocks, but look to other areas of the market. How about international stocks, municipal bonds, some of those unloved sectors like utilities, consumer staples, healthcare? Those are areas where we see growth potential, and also they're trading at much more attractive valuations than technology right now.
So you're still not concerned about a global growth scare. Let's just square that away for now, because we vaulted from huge growth scare to Goldilocks just got some toxic porridge. So where do you sit?
I've seen that growth scare since the first quarter of this year. Actually, we saw GDP coming at just 1.3%. We've now seen unemployment rise to 4.3%. We know the total amount of household debt outstanding in our country and the early delinquencies starting to take place in credit card payments. That's so important for the U.S. economy because the consumer accounts for 70% of our GDP growth. However, the Fed is aware of this. They're more concerned with this slowdown than they are with inflation staying above 2%.
Well, here's the thing. I mean, by the way, this came from Torsten Slok. This is the default rate is actually declining. So again, this perhaps detracts from the really hard landing narrative that we convulsed about on Monday, doesn't it?
It does, but the soft landing is still in question to me, and it is still in play with the Federal Reserve.
So I would say that soft landing is even more in question. I look at, so I've got the Atlanta Fed GDP tracker at 2.9%. You go, okay, that looks pretty solid.
Very solid.
Okay.
Compared to first quarter, without a doubt.
I see you and raise you. Nike, Delta, Airbnb. You got to get out there and get on your holidays. But on a slightly less frivolous way, Nike are warning, Delta are warning, Heineken are warning about the U.S. consumer, and Airbnb are saying, what is it they say? There are signs of a slowing demand. I would say I listen more to what the CEOs and the forward guidance is from Nike, Delta, and Airbnb than perhaps some of the other data.
Yeah, I would suggest that second quarter earnings have been strong. We've seen year-over-year earnings growth, the highest it's been since the fourth quarter of 2021. But we've also seen now 39 companies issue negative EPS estimates for the third quarter. So all of these companies, not all of them, a lot of them are suggesting that the U.S. consumer is becoming more frugal, more value-oriented. If they become more frugal and value-oriented, that suggests to me they're going to spend less. If they spend less, the economy slows further, and the Fed's going to have to step in and cut interest rates to help stimulate demand as opposed to dampen demand as they've been doing over the last year and a half.
How brave have you been? I've had a number of calls and emails. I need to call somebody back today, which is about dollar averaging. But again, on a slightly more serious note, institutions have been brave. $14 billion worth of equities were bought, according to JP Morgan. Goldman Sachs has said very clearly the hedge funds are calling in from the Hamptons. I mean, they were the most underweight tech that they've been in 10 years, and they've flipped.
Yes.
So how brave should I be? Should I follow that institutional narrative, or is that opportunity done? Is this a short-term trading range that these boys and girls are jumping into?
Yes. At Hennion and Walsh, we always remind our clients what's more important isn't trying to time the market, which we all know is an exercise in futility, but it's time in the market.
It'd be nice to get it right sometimes, though, wouldn't it?
In fact, though, we looked at a study over 31 years, and what we found was that 95% of the gains in the stock market come on just 1% of the trading days. Now, I don't know when those 1% of the trading days are going to be, but I can assure you this, Manny, if you're not in the markets on the 1% of those trading days, you can't participate in the most significant gains that the stock market has to offer. So stay invested, stay diversified, be true to your risk tolerance, and over the longer term, you should have a happier outcome.
The best line that I saw about big cap, which was, it's a bit like a Birkin handbag that's 10% cheaper than it was before the crisis of confidence. So you say don't abandon large tech, but do you see it as an opportunity? If you see NVIDIA down 20%,
yes.
Does that smack of a great opportunity for you?
To me, it really does. I think the AI game is a long game. In fact, I used a baseball analogy earlier on your show, and I said I think we're just in the batting practice of a double header. But look beyond just NVIDIA. Look beyond the semiconductors and chips companies. How about the data centers, the hardware companies, the software companies? Build a diversified portfolio and recognize that AI investing is a long game. And these companies that are devoting significant capex to AI, it will take quarters, if not years, to get a return on investment.
Danny's got a lot to do. She's got to take me to baseball. She's got to take me to American football. She'll be up in surveillance a little bit later on. Kevin, good to have you with me around the desk this morning. That is Kevin Mahn of Hennion and Walsh Asset Management. Coming up in the show, cautious on theme parks, bullish on films. Inside Out 2 is expected to help Disney's film division see its first profit. More on Disney's earnings. That is next. Context matters every day from New York on Bloomberg.
Donald Trump's not fighting for you or your family. He never sat at that kitchen table like the one I grew up at, wondering how we were going to pay the bills. He sat at his country club up in Mar-a-Lago, wondering how he can cut taxes for his rich friends.
Minnesota Governor there, Tim Walsh, speaking at a rally in Philadelphia yesterday after being officially named as Vice President Kamala Harris's running mate. Joining me now is our Bloomberg government reporter, Courtney Rosen. Courtney, today it's Michigan, it's Wisconsin. What's the target audience? Of course, it's the real workers of the United States of America.
Today's focus is on courting unions. The United Auto Workers president, Shawn Fain, is going to appear with the pair in Michigan, in Detroit, Michigan, later today. President Biden, a big part of his support was unions, union leaders, union workers, and he spent a lot of time building and cultivating that relationship. Now, Vice President Harris and Governor Walz, in their bid for the White House, are going to spend today working on that as well.
Of course, Biden appearing on the picket lines during the auto strikes, which is one of those sort of very poignant moments in the past year when there's been real friction. This man is a money raiser, the vice president. He's a coin producer. How much have they raised since they announced he's her running mate? And overall, what does he politically bring to Harris's campaign?
The campaign says that they've raised $20 million for their run for the White House since the announcement of Governor Tim Walz yesterday morning here in the United States. We're expecting, Tim Walz, if you look at his bio, they've played up his experience as a coach, a high school football coach, his experience in the military, his experience as a dad. Those are all different experiences that he brings to the table compared to Vice President Harris, right? So we're going to see a different personality catered to a different set of voters in the Midwest for sure. Vice President Harris is from California. He's from Minnesota. So we're seeing a lot of opposites or differences, which is intended or purposeful to cater to a different set of Americans.
And obviously, we're building up to the Democratic convention in the next few weeks. You know, how does that change? Anne-Marie was with me a little bit earlier on, and she said that the energy in that room yesterday evening was palpably different to what she'd seen perhaps at some of the Biden gatherings. So what is going to be the focus between now and then and at that convention?
The focus is going to be introducing Governor Walsh to the country. He's not very well known outside of his state of Minnesota. So that's number one. And number two is going to be building that enthusiasm, that energy going into the convention. We're seeing a lot of star power brought to Vice President Harris's rallies. You'll see singers, DJs brought that are really intended to draw people out and build some enthusiasm. And so we're going to see them continue to try and build that going into the convention later this month.
Okay, we'll keep our eye on that today in Michigan and Wisconsin. As you say, a clarion call to the unions. Courtney, thank you very much. Courtney Rosen there on the very latest on the campaign trail. Earnings. Disney results will hit before the bell today. Now, it's expected to show the film profit, while analysts expect a cautious tone on the theme park business. So how's it going to play out? Tom McKenzie is with me. Tom, it's a balancing act, really, isn't it? We've just heard from Airbnb warning about bookings being on perhaps less steady ground. So it's going to be interesting to see what they've got to say about the theme parks and perhaps the forward guidance. Good morning to you. What can I expect?
Yeah, Manus, look, you're right. This is a gauge on the consumer, of course, as well. And the earnings coming after they raised those prices across Disney+. So from between 10% to 25% in terms of the increase that's coming through, which for Bloomberg Intelligence speaks to Disney's pricing power, the fact that they have this pipeline of content to put onto the streaming service, and the fact that in terms of their viewers, their audience, it remains relatively sticky. They can hold on to those viewers and that audience whilst also pushing up prices. And it's a reminder as well that across the streaming space you are having those increases in terms of pricing, whether that's from Netflix or Comcast's Peacock or other competitors in that space. Disney aiming, one of their key aims, of course, is by the fiscal fourth quarter, they want to have that streaming service profitable. So that will be one area that we're looking at. But then, of course, you've got the theme parks, you've got the breakdown around subscriber numbers as well, and the films unit. And I can break those down for you, Manus. I know you're a Premium Plus subscriber, obviously, to all things Disney.
Yeah, I'm there, buddy. I've got more, you know, apps for watching TV than I've ever had in my life, but we can't name them all. I'm just curious. I mean, it's a pretty, there's a word that I could use, but I don't think we can use it on daytime television. It's a pretty robust move, let's say, by Disney to go for a 25% increase. Just as you see Airbnb warning about slowing demand, just as you see Heineken saying we're worried about the U.S. consumer. I mean, this is a high-wire act. If the consumer is seriously challenged, why do you think they're going for this hike now? Because Hulu and ESPN also raised their prices. One could say there's a wonderful concert together here.
I know the word you're reaching for, but let's go with punchy. And it is punchy, Manus, in terms of raising prices at a time when we're all questioning whether or not the US is heading towards recession, of course. But again, I'll take you back to the Bloomberg Intelligence analysis, which is, first of all, they've got the content to keep their viewers hooked to their streaming service. Number two, there's evidence to suggest that very few viewers are actually cutting the cord on Disney+. And number three, they need to hit profitability when it comes to Disney+. They've set themselves that key target. We're going to be looking for the subscriber numbers, of course, when the earnings drop pre-market. In terms of the most recent quarter, the estimates are that they're going to come in with about 154 million subscribers. The film unit, really interesting, expected to turn a profit for the first time in over 2 years, thanks to one of your film favourites, Inside Out 2, which has been very successful. That's expected to make up to some extent from what's happening in the theme parks business. To your point around the softness in the consumer, the theme parks is expected to be a little challenged. The outlook there may be a bit more conservative. So watch for that on theme parks, which still makes up about 2/3 of revenues for this company. So you've got the theme parks, you've got the films, which could come in slightly stronger on the back of that content. And then, of course, you've got the subs numbers around Disney Plus to watch for. 154 million is what's expected. Morgan Stanley saying they've got to be aiming for double-digit margins when it comes to Disney+. We'll see if they get one step closer to that, or, to your point around caution, whether actually consumers recoil at these pricing.
Yeah, I mean, the fight back, it happened a little bit with Coca-Cola. Tell me now, do you pay to live without the ads or not?
It's got to be ad-free, hasn't it, Manus? For now, at least. We'll see how everything else lines up. Be more selective in your streaming services. Go ad-free.
Go ad-free. Disney Plus without the ads, 14% rise, $15.99. What a bargain.
Yeah.
Tom, thank you very much. Keeping it real on Disney. Quick snapshot of what's going on. The air cover has arrived in a verbal intervention from the Bank of Japan, from Uchida, which is we will not raise rates for as long as we see a market unstable. Volatility is high in the FX market and in the equity market in Japan. So what you've got is the dollar, of course, repricing there. By the way, dollar yen has shifted from a low of 141.70 to 147.36. So a great deal of this move has been done. And the dollar index up 1/8%. Stronger GDP tracker data yesterday saying things are fine here in the United States of America. Euro dollar down by 1/8%, 109.11. Coming up, a big day for earnings and economic data. I'll run you through what's on the slate right here on Bloomberg. It's Bloomberg Brief. I'm Hennion in New York. A quick check on what's ahead for your day. Disney, as we previewed for you, what will the film unit deliver as they put through price rises of 25%? Lyft report their earnings before the bell. The numbers in the US consumer credit hit the tape at 3 p.m. Eastern. And more earnings after the bell. Warner Brothers, Discovery, along with Robin Hood. These are some of the stocks that are on the move. Airbnb, disappointing outlook, third consecutive quarter, and warned slowing demand for US vacationers. Rivian, also under a bit of pressure this morning, down 8%. Second quarter revenue misses the estimates. The cash burn for the period was bigger than expected. And as I said, Disney earnings before the bell. I want to show you what's going on with the bond market because you saw a significant repricing in bonds yesterday, up 10 bips on the 10-year government bonds. We're adding to that this morning, up another four pips this morning. Now, Bill Dudley has just delivered his opinion piece, again, vindicated really in his call, pivoting from hawk to dove. He said the Fed needs to get to neutral. And the estimate of neutral is 2.4 to 3.8%. And he put himself in the top half of that range. More on that through the morning. European government bonds also flying higher. You do have an auction today, $42 billion worth of 10s, $25 billion worth of 30s tomorrow. But I like what BMO had to say, rethinking the rethink. The cuts are getting slashed. The proclivity to cuts are getting slashed. And that is essentially what Bill Dudley is talking about this morning. That's it from the team here on Bloomberg Brief. SPOOs are up 1%. The surveillance team will take you through the next 3 hours debating the scale of the air cover delivered by the Bank of Japan and to what extent it really does allow you to relock, reload, and take more risk or de-risk while you've got a window.